Welcome to the podcast from Morningstar UK, the leading provider of independent investment research. This week, we're focusing on millennials, fund fees, and building investor trust. What do the millennials expect from their financial future? When do they see themselves retiring, if ever? And would they ever pay for advice to help them achieve their money goals? Senior editor Emma Wall took to the streets to find out firsthand.
So I'm just asking students and young people aged 18 to 25 what their career aspirations are and how much they'd like to earn. What would you like to do?
I want to do computer science.
Well, I was thinking about environmental law.
I'd like to try out a few different things, like maybe teaching, doing some travelling.
I would like to work somewhere in the finance industry here in London.
I'm thinking about doing scientific journalism.
Something in development or kind of public economics.
I'd like to do music if I could, but otherwise I think I'll carry on in academia.
Well, ideally I'd probably want to work for the EU in Brussels.
Probably architecture.
I would like to work for a consultancy company, but then maybe set up my own business.
And how much would you ideally like to earn?
Well, living in London, I guess, I don't really know, maybe sort of upwards of £150,000.
I'm studying to be a student midwife, so realistically my career aspirations would be in terms of the NHS, and so it's kind of banded. So realistically my initial salary would be I think around £30,000 to £35,000.
100,000.
Maybe like 60 or 70 grand.
Like about when you're 30 years old, it should be, let's say 100.
Enough to live on and a bit more than that, so like maybe 40k a year.
And what about retirement, which must seem like a long way off at the moment, but what age would you like to retire at?
Yeah, that's a really hard question because I'm really now 21 and it's hard to predict. I never thought about it.
Well, as early as possible, ideally, but again, if like that's my chosen career, I don't see it being beyond 65 and possibly being pushed back even later considering the changes in NHS and the fact that I won't have a pension to retire on.
Something around 60.
Well, I'd like to retire like 65, but that's not likely.
People are able to do a lot more and like be active members of society a lot longer, and like I think it's important to recognise that and not just kind of write old people off as like a social burden.
What's the retirement age at the moment? It's
Around
about
65 at the moment.
Sounds about right.
Marry rich and then retire straight away is the ultimate dream.
Sugar mummy.
Yeah, exactly. So if you know any.
Yeah, I'll let you know.
60, 62.
I like to keep my mind busy, because when you stop thinking, you start developing chronic diseases and, dementia and stuff.
Well, I feel like architects can work all their life, really. I mean, you've still got like Richard Rogers, Norman Foster, they're going and they're still like 80.
I kind of assume that we'll, as millennials, have to work till we're about 90.
If you could pay a professional some money while you were earning to help you retire early or to help make your retirement more comfortable, is that something that you would consider doing?
No. No, probably not.
It'll be foolish not to sort of engage in a service or a person who can actually help me maximise that, rather than carrying on thinking I know what I'm doing when I clearly don't.
Realistically, I don't think that would be where my money would go because I wouldn't have additional money to pay someone. And I think that's probably the case for a lot of people living in London, and particularly young people don't think about the future because they're struggling so much in the young age.
No, not really.
Nah, probably not.
I'd much rather go to people I know and ask them how they've done it, like ask my dad how he's done it or whatever, if he had already retired by that stage, which obviously he would if I was 62. He'd probably be dead. But
I think the best decision what I can make is my own decision, so I can save by my own, not to have any help from any financial advisory.
Maybe I'm sort of naive about these things, but I never think about how, how you invest or whether to have an early retirement or thinking about, I really just don't think in those terms. I mean, I don't think I would pay somebody, well, I don't know, it depends how persuasive they were.
It may be decades away, but smart millennials should start planning for their retirement early and harness the power of compound interest to avoid pension poverty, explains Emma Wall up next.
They say youth is wasted on the young, but before you get jealous of your child or grandchild, consider the difference in financial circumstances between the millennials, that is those aged 18 to 25, and the baby boomers, that is those aged 55 plus. First, let's start with education. That was free for a number of baby boomers, including higher education. Millennials have had to pay up to £10,000 for tuition fees, and that's before living expenses get going. So they're starting their careers, their working career, with a shed load of debt. When they get there, when they get to the workplace, they're going to start saving to get onto the property ladder. House prices over the last 40 years have gone up 40-fold since around the 1970s. And of course, when they're saving for these unaffordable properties, they're not saving for their future. Saving for their future has also changed. Those millennials will be looking at a DC, defined contribution pension scheme, and baby boomers had the benefits of a defined benefit scheme. What can the millennials do to redress the balance? Well, they can harness the power of compound interest. Auto-enrollment helps with this because this is the generation who are going to benefit from their entire career saving into a pension scheme because they'll be opted in. Unlike when we used to have to opt in ourselves, not often leaving that decision to our 30s and 40s. With the power of compound interest on their side, these millennials really should look forward to a pension without poverty.
Millennials are adopting lifestyles mindful of their impact on society and the environment, and they want their investment portfolios to reflect this commitment too. San Lee, Director of Manager Research for Morningstar Benelux, explains why millennials are leading the way with sustainable investing.
So we're here at the Morningstar Investment Conference in London, and you've just been speaking to the room full of advisors, educating advisors about how to use the new Morningstar rating. But let's leave that to one side for a second. And I wanted to look at ESG investing as a whole. It's still in its sort of new stages, ESG. Who is engaging with it at the moment? Is it institutional? Is it retail investors?
Well, thus far it's mainly institutional. We see a number of pension funds, especially in the Nordics, in the Netherlands, that for them it's really a big, serious issue. So they screen their whole portfolio based on the environmental impact, social impact, etc., etc. But we also see a shift towards retail investors, mainly through high net worth individuals initially, but also retail that are interested in it. And especially, I would say, millennials, so the newer generation, but also female investors, they apparently really want to express their own personal values also in their portfolio.
And this is not just something that we're seeing among millennials when it comes to investing, is it? It's a real psyche shift among that age group, that they want to see ESG in all parts of their lives, don't they?
Exactly. I mean, if you look at, for example, cars, I think our generation, we all want to drive our own car, whereas millennials, they don't mind to share a car. It's about employers they look for, also there they want to see that their employer is also, looks at the broader, societal impact that they have. If you look at where they, buy their groceries, it has to be all organic. So you see a big shift in the newer generation, and I think that's very interesting that perhaps now, a lot of retail investors, especially perhaps, but older generation, don't care that much, but especially the new generation, they really want to embrace this and want to see their values back in their portfolio.
Absolutely, because if you're applying those very stringent tests to where you want to work and where you want to spend your money, it makes logical sense that when it comes to investing decisions, you won't just abandon those morals. You will want to apply those you want to invest your money with those types of companies as well.
Exactly, and it's also, if you take it a bit further even, you see, for example, impact investing, which is even more looking what's really the impact of your investments. So not so much looking at the financial return, but also at the social return. So take, for example, microfinance, where you know that as an investor you hardly get any financial return, perhaps 2-3% max, but you know that the money that you invest is really going to poor families and small entrepreneurs that are making your money work. So indeed, I think especially that generation wants to see what's happening with their money, wants to see it work, and of course they're interested as well in let's say financial return. It's not philanthropy, but they also want to see how it's has really a big impact on society.
And if retail investors want to make these ESG-driven investment decisions, how can they use the new Morningstar rating to help inform those investment decisions?
Well, I think that's the great thing of our new ratings, that we really bring it from the institutional world to the retail world. So on our websites across the globe, people can access these ratings. And if you are interested in a certain fund in a certain category, of course, you can already look at the financial, the risk-adjusted returns. You can look who's the manager. You can look at our analyst ratings. There's a lot of ways to look at a fund. And this is really this additional lens that can help you if you have, for example, two funds that look very similar in terms of strategy, performance, etc., etc. If you're also interested in, let's say, the environmental or social impact it has, then these ratings are a great tool because you can compare. Like with our star ratings, what are the best 10%? So they get 5 globes. The worst 10% gets only 1 globe, and the rest in the middle. So it can really help you to pick the right fund, which is really much in line with your own values.
Sam, thank you very much.
Welcome.
Can ESG investing mitigate risk in emerging markets? James Donald, Emerging Markets Fund Manager at Lazard, explained why he only invests in companies which treat all shareholders in a fair and equal way, as well as some of the pitfalls in investing in emerging markets.
Hello, James.
Hello.
So ESG is a hot topic at Morningstar. We're looking into the ways that good ESG can mean fantastic returns for investors. And it's something that you've been applying to emerging markets for some time, isn't it? Looking at how governance can help you shape investment decisions. I thought perhaps we'd start by highlighting some of the pitfalls, some of the risks investing in emerging markets to do with governance that may not exist in developed markets and those that are more transparent.
Well, emerging markets are already a high return but high risk asset class. So you already have risks that you probably don't have so much of in developed markets. But also shareholder protection is lower. You also have control groups in almost all emerging market companies. And as fragmented minority investors, we're at a disadvantage against those control groups.
And part of that is to do, as you mentioned there, is to do with the fact that the structure does not exist to prioritise shareholders. Now, it's getting better, but shareholders are not at the top of the priority list in emerging markets, partly because there's a lot of state-owned enterprises. I'm thinking in China, for example, where the shareholder will be not top of the company's priorities.
Yes, I think that's right. I think it's not just states, but states are important, but also local groups and multinationals. And they can take advantage of minority shareholders remarkably easily if they want to. And that's really what we're trying to look out for. We don't necessarily want to be the absolute priority. We want all shareholders to be treated in a fair and relatively equal way.
And how do you use governance then to inform your investment decisions?
Well, when we're interested in a company fundamentally, we'll then move on and have a look at the history of governance with the company and what we think the future will also entail. So the history involves looking at historical abuses, whether they've treated different groups, not just shareholders, but also the environment, their employee base, other entities in society, how they've treated them in the past. We think, even with other elements in society, there's a risk to treating them poorly. We also look at disclosure, the company's communication with shareholders, and then as more of a future-focused area, we really tie in whether we're aligned to the management and the control group. So we want to see that management, for instance, if possible, is encouraged through a variable compensation that's logically derived, that's material, and that hopefully is paid to a large degree in restricted shares, because we think we're very aligned with groups on that basis. With the control group, again, it's whether we believe we're aligned with them, and then finally, whether it's one share, one vote.
And you're not doing this to have a warm, fuzzy feeling inside because you feel passionately about ESG, or you might be, but also these things go hand in hand with long-term returns, don't they?
We believe that governance is a major risk issue. And if companies don't treat other parties, and particularly shareholders, on a relatively equal footing, then you will have worse relative performance over time. We can learn by investing with groups that treat shareholders relatively well and relatively badly.
And how do you use your position once you are a shareholder in a company? Because one of the great things about being a shareholder is you can help to positively influence that company when it comes to decision making.
Well, we almost always discuss governance with companies when we meet them. And we express quite strong views on how we think companies should compensate, how we think companies should behave in certain situations. We also offer ourselves often as almost an advisor to companies in certain situations where they're concerned about a governance situation and where they might want to have a question an investor and see what they think about the situation themselves.
James, thank you very much.
Thank you.
Don't pay high fees for a low active share fund. Most of the portfolio of a low active share fund you can get at really low cost in an ETF, says Martin Kremers, Professor of Finance for Notre Dame University, up next.
Hello, Martin.
Hi, how are you?
Very well, thank you. I thought you're the man to ask, what is active share?
Well, that's one of my favorite topics. Active share is a new tool for investors. It's a really basic measure that compares the holdings, the weights of the fund, to the holdings or the portfolio weights in the benchmark. So active share measures how different the fund holdings are relative to the benchmark holdings. So a high active share means that the fund owns very different securities than the benchmark.
And of course, high active share sounds like a fantastic idea because it sounds like an active fund manager is earning their keep. They're deviating from the benchmark. But with all the considerable volatility that we've seen in markets recently, fund flows have actually left those managers with high active share because people see that their fund is doing different from the benchmark and they have short-termist nature. They're scared of risk. They're scared of losing money. And so therefore, they're not actually backing those active choices from a fund manager.
Yes, that's right. So if you have a higher active share, it may lead to more volatile performance relative to the benchmark, but it doesn't have to be, right? Some active managers are able to be well diversified as well as have active share. And so the two things are not completely the same, right? High active share means you're different, but you can still have good risk management and still be very well diversified. More generally, I would say that investors should be careful not to judge managers over too short horizons. It may take a while before you figure out if a high active share manager is worth your money. And so but it does mean that before you invest in a high active share manager, you may need to have a higher level of trust in this manager.
And is high active share good? Can we make a blanket statement such as that? High active share better than low active share?
No, certainly not. Active share is a very basic tool in a large toolbox. It just measures how different the holdings are. To make a really obvious point, I don't need any skill in investing to get a high active share portfolio. All I need to do is just buy a bunch of different stocks. So of course, for successful investing, you need a lot more than just buying a bunch of different stocks than are in your benchmark. Nonetheless, I would argue that active share tells you something really important about the manager, namely how different what you're buying is to what you can get really cheaply through ETFs or index funds. So at the very least, investors should not pay high fees for a low active share manager, because again, most of the portfolio for a low active share manager you can get at really low cost in an ETF or index funds. So at the most basic level, active share tells you something important about what the manager is doing, and then by combining active share with other interesting characteristics of fund managers, like volatility, tracking error, turnover, costs, you can get a better insight on what the manager is trying to do.
And do high active share funds perform better in a certain part of the market cycle? For example, you could argue that while the S&P 500 has gone great guns since the global recession, owning an ETF, tracking that index was probably the smartest thing to do. Whereas now it's a lot more difficult to find growth. Is now the time to be backing those high active share fund managers?
I find it a very difficult question to answer, also because my data doesn't include too many different market cycles, right? So my data really starts in 1990. And there's been a limited number of market cycles in there.
We've had 2 big hikes and 2 big crashes since then, though.
Fair enough. And my own research doesn't suggest very strong differences across cycles. What my research does suggest, though, is that stock picking seems to work best among small cap managers and global equity managers. And a particular interesting combination would be high active share managers who don't trade very much. So really the patient high active share managers. One of the main results that is in my new research is that among high active share managers who as a group have outperformed to some extent over the last 25 years, it's really only been the patient high active share managers that have done very well. And so again, the combination of high active share with patience, that's a difficult strategy to run. You also need patient investors, referring back to one of your earlier questions. So it's hard to do, but the managers who have been able to do it have been quite successful doing so, at least in my sample.
I can think of one good example in the UK, and that's Nick Train. He's definitely a buy and hold advocate, and he's very highly rated by Morningstar analysts as well.
Okay, very good.
Martin, thank you very much.
Yeah, thank you.
Has the city been behaving badly? Hermes Chief Executive Sako Nusebe believes fund managers need to earn the trust of investors, starting by caring about their clients and being honest about outcomes.
Hello, Sako.
Hi.
So we've just had a really interesting talk about fees across the board, fund management industry, advisors and platforms. But you're here representing the fund management industry. And one of the things that was raised is the fact that assets under management in the fund management industry have grown incredibly over past decades, but yet economies of scale have not been passed on to the investor. Why is that?
I think because fund managers have made fund management a much more complex business than it needs to be. I made the point in the speech earlier that when I started, we did something called balanced. We now do outcomes and solutions, and we charge a little bit more from it. But you can take this to an extreme. It's a business. Asset management is a business. And it's partly responding to what supposedly sophisticated clients want. So you have more siloed products, they're more complex. Because they're more complex, you charge more for them, etc., etc. Now, is it justified? I don't think so. Look at the margins of the industry. I don't think it justifies the margin as a whole.
And you spoke quite candidly about the lack of trust and the lack of honesty in the industry. You told a story about once you went to a client and you had to persuade them that now there was not the right time to be in a particular product, and actually the client didn't want to take their money out. Yep. Why do you think that fund managers do not do that enough? Because I've never heard a story like that before.
It's because fund managers convince themselves that they're doing exactly what the client wants. And the way they say it is, and you'll often hear fund managers say this, we do what it says on the tin. I gave an analogy about going to my doctor. Now, when I go and see my doctor, I don't actually expect him to do what it says on the tin. I expect him to look after me. And even if it doesn't say so on the tin, if he thinks there's something wrong, he should tell me there's something that's wrong. So fund managers will convince themselves that as long as they're doing what it says on the prospectus, they're okay. We at Hermes take a very different view. We take a view that actually we should be honest with our investors. So in the case of the example I gave you, we came to the conclusion that we're a high alpha manager. This is not alpha, this is just beta, it's disguised. So we went back to all of our clients and said, please take it back. And they were not happy, actually. They were rather upset because, of course, they'd convinced themselves that this is skill and that's what they wanted to go through. We're different as a fund management business. We believe sustainability means you have to bring back honesty. We have a pledge. We're the only asset management business in the world. It's ridiculous, that has a pledge that says, I'll put the interests of my clients first. I'll be transparent with everybody. I will actually look after the environment. It's extraordinary.
And what more then do you think fund managers should be doing, other than obviously be more like Hermes, with that commitment then to put investors first? Because of course the IA tried to get people to sign something along those similar values, and people didn't sign it. And it was a very simple statement saying, you know, I will put my investor, my client before myself. What's gone so wrong?
I think it goes back to this thing about complexity and siloization. I think fund managers kind of need to rethink about what it is that we do for a living. If I think what I'm doing for a living is very simply delivering whatever product I'm telling you I'm delivering within the parameters of the volatility, volatility I'm telling you at, then actually all that I'm doing is I'm selling you a car part. And if I think I'm selling you that, It's up to you to decide whether it's good or not. That's not what we should be doing. We employ very clever people who really understand the market, and they really should think, why are you buying this thing from me? You're buying it because you want to retire in 30 years. Is this going to help you? Is this the right decision for you? And I again make the analogy of a doctor. If I go to a doctor and I say I want to do something to my body, I expect the doctor would say to me, this is not good for you, please do not do it. Or this is good for you, you might not like it, but it's good for you. And that debate is not there. When we talk about the savings debate, for example, no one is saying to clients, by the way, and including your type of clients in the Morningstar universe, individual clients, you're not saving anywhere near enough. And you understand it's not enough. And don't bank on your house. Nobody cares. So the first part of trust is to actually care.
And do you think then with caring, along with transparency and honesty, that trust will come? Because it's very much lacking, especially in those under 40. They think the city is a big, bad, evil place.
And they're quite right, because the city has been a big, bad, evil place. And the city has, in 2008, resulted in a disruption to the economy. And look, we're a long way to come out of that mess that was created by the city. So yes, the city should make an effort to try to win back trust. And it can happen. It wasn't always that people trusted lawyers. Read Shakespeare, where he curses all lawyers. Now, generally speaking, we trust them. It wasn't always that we trusted surgeons. Now we trust them. They earned the trust. And fund managers, in general, the city has to earn trust. And it's important, by the way, not just because of the underlying clients only, which is the key point, but it's also important for us as a nation. The city is the heart of our economic strength. It's given us as a country power for 300 years. Unless we look after her, and that means make her trustworthy, sustainable, long-term, she's not going to be here to serve England for the next 300 years.
Saka, thank you very much.
Thank you.
And that's the end of this edition. We hope you enjoyed this programme. From everyone here at Morningstar UK, thanks for listening.